Hi everyone, the stock market is like a giant puzzle. Every piece, indicators, news, volume, trends has its own place. But there's one big piece that holds the entire puzzle together, and that's the market structure. I struggled a lot without understanding market structure in my initial days. All those other tools felt scattered, and I thought that I am just playing with random pieces and trying to force them together to solve the market puzzle. But once I understood how price moves, shifts, and reacts, everything started to make sense. I began to see why the market moves the way it does, and more importantly, where it could move next. Hi traders, welcome to my YouTube channel Mighty Bull. In this video, let's break down market structure in a simple visual way so you also can finally start connecting the missing piece of the trading process. By the end of this video, you will understand how a price chart is formed, why market structure is important in swing trading, 4 stages or phases of market structure or market cycle, when to play aggressive and when to be defensive, different structures of market cycle, and how to identify the best market structure for swing trading. I had divided this market structure video into 2 parts. In part 1, I will discuss about the broader view of market structure, which we can also term it as market cycles, and the structures of those market cycles will be discussed. While in part 2, I will go in depth and discuss the focused view of the market structure. So kindly pay attention to this video and watch till the end. How a price chart is formed. To understand market structure, you have to understand how the structure is formed first, right? See the candle here. It's a daily candle. This candle tells the story of the buyers versus sellers on that particular day. If the buyers are strong, the price goes up and ends in green, while if the sellers are strong, the price goes down and ends up in red. A few days of this price war between buyers and sellers lead to the formation of candlestick patterns like bullish engulfing pattern, inside bars, morning stars, etc. After a few more days, it leads to formation of chart patterns like cup and handle, volatility contraction pattern, high tide flag, etc. As days pass on, the market, when zoomed out, would have formed a structure, and that structure tells the story of the stock or the market for the past few years or more. Why market structure is important in swing trading? This market story is important to understand. Understanding the market structure forms the backbone of swing trading. It acts as a guide to get a clarity on what will come next, what will happen. It guides us to the path where the smart money is, where the institutions are focusing, and finally where the demand is. Think of swing trading like playing on a swing. At first, you put in a little effort to get it moving. That's your setup. Then you enjoy the ride as momentum carries you higher. That's your profit phase. When you feel the swing is about to stop or reverse, you simply get off and move to another swing, right? That is exactly how big institutions trade. They ride the momentum, and when the momentum fades, they move on to the next opportunity. So understanding market structure helps us to see where the institutions are positioned themselves. The 4 phases of market. Market movement is never linear, you all know. It always goes in up and down movement. Each stock at any given point of time will be in any one of the 4 stages or phases as shown here. Stage 1 is the accumulation phase, stage 2 is the markup phase, stage 3 distribution phase, and stage 4 markdown phase. First is the accumulation phase, where the smart money starts to accumulate the stock that is completely off radar to the retail investors. The first buyers are the contrarian investors who buy the stock when the opinion is contrary to the larger public. When the larger public and even big players are skeptical about the stock, contrarians bet on these stocks, analyzing the future performance and earnings. Then comes the value buyers who starts to buy the stock based on its intrinsic value. They start to buy when they find that there is a discrepancy in the current price of the stock and its fundamental value. The stock in this phase trades in a range, moving up and down. This range may vary from few weeks to even years before the stock starts up to run. The second phase is the markup phase or stage 2 phase. As the buying keeps on increasing, the demand for the stock rises and it further pushes the price up. Finally, it will break above the range it was trading for weeks into a new high. Seeing the breakout brings the interest of momentum players. They start to buy the momentum with vigor and the stock starts to fire up. This phase is called markup phase or stage 2 as called by Stan Weinstein. I had made a 3-part series on Stan's trading strategy. If you are interested, you can go and check my playlist. Once the stage 2 gets confirmed, the stock is no more underwater. It has exploded and has now got everyone's attention. More and more retailers starts to buy the stock and each pullback will be seen as an opportunity to buy the stock again, making it to reach new all-time highs. The pullbacks in this phase will be shallow and the entire move will be filled with big green candles and small weak red candles. Now coming to the stage 3 phase, also called as distribution phase. This is the phase where smart money wants to get rid of the stock. They start to dump it to the retailers who are in buying frenzy. It is the time where the institutions trade their stock for retailers' dream. The price movements which were till date organized becomes clumsy. You can see wild volatile days and big red candles starts to appear, which is just opposite to stage 2 markup phase. Each move up will be met with selling pressure and the stock starts to trade in a range again. The range will be wide, unlike accumulation phase where the range will be more organized and tight. As retailers continue to buy the stock fueled by recent euphoria and highly positive news flows, they give enough liquidity for the smart money to move out easily. So here the distribution is in full swing. You can see it. Coming to the stage 4, it is called as markdown phase. When the majority of smart money has moved out, the stock finally breaks the distribution range on the downside with a huge red candle or a gap down. Now the stock is filled with weaker hands who don't know anything about the market. They had bought the stock because they believed that it will move up. When things go south, they panic. They press the sell button in a hurry to get out of the trade. Short sellers join the trend and short the market, bringing the price even down. As more and more people starts to sell the stock, the price starts to bid lower and stock plummets to new low. Entire weak hands would have been wiped out by now. Once the weaker hands move out, the market cycle repeats as the stock will form a new stage 1 base. So when to play aggressive and when to be defensive? As traders, our job is to stay with the smart money and ride the trend along with the institutions and get out when the stock shows signs of distribution. In that perspective, it becomes clear that as a long only, that is buy side player, we should be aligned when the momentum picks up in the stock and starts to move into stage 2 from stage 1. This is the market phase where you should be aggressive. All the other 3 stages you sit out or play defense. Coming to the different market structures. Though the market cycles or phases which I had described above is common knowledge, readily available in social media, one key aspect is missing in the details. That is how this cycle play out as a structure. It's not always black and white as you see in this picture. Now I am going to discuss 3 different market structure that exhibit these 4 cycles. This is the key for your trading success. So listen it carefully. The first is the turnaround structure. See this chart. The chart after going from stage 1 to 3 started its downfall and has given up almost all the move it made in the previous cycle. Now it's again in the formation of stage 1. This structure is called as a turnaround structure. Now of course the stock can run up into stage 2 from stage 1, but it has huge resistance on the left side and there should be a reason why the stock has fallen off this much. For the stock to make big moves, it should have a good turnaround story. Its fundamentals should have improved a lot. Its earnings should be rising and sales roaring. One should have good knowledge of why the stock is showing the turnaround structure and why the smart money should again be interested in this stock. If your analysis is even a bit off, this structure will have frequent shakeouts and failures. I avoid this structure completely as I have plenty of other stocks in the market to trade. So coming to next is corrective structure. The second is corrective structure. This is the most important type of market structure because it is very common. The stock goes from stage 1 to stage 2 and after reaching a new high, the stock corrects and goes into stage 4. But if you see closely, this correction will not go below the previous stage 2 run. At the best, the correction will be less than half of the last stage 2 run. This structure gives the best risk to reward ratio for the traders and gives the confidence that the stock is still in long term uptrend even after the recent correction. The structure is easily identifiable and is very common during broader market corrections. The third one is continuation structure. This structure is the most powerful of all the structures described above. Here the stock runs from stage 1 to stage 2 and then goes into stage 3 or distribution phase. But instead of breaking down into stage 4, the stock breaks up again into stage 2, continuing its bull run and reaches a new high. If you find such a structure when the broader market is in a downtrend, then you have found your next market leader. It is the leader you want to focus on. This stock has defied the broader market's down move and has stood firm. Imagine what will happen when the broader market starts to move up. This is the structure I love the most. You should focus such structures to make huge gains in the market. See another example of a chart where the stock goes from stage 3 to stage 2 without breaking down to stage 4 and breaks into all-time high zone. I hope this point is clear. So coming to the most important key takeaways of this video, the market structure is the basis of trading as stocks always moves non-linearly. Look for stocks that creates transitions from stage 1 base to stage 2 base. Strongest are the stocks that move from stage 3 to stage 2 into all-time high zones. Understanding this market structure will help you avoid trading disasters and blowing up your account. So hope all my points were clear for you. That's it for today, guys. We'll come up with a new video where we will deep dive into price action concepts in an easy way. Like, comment, subscribe to my YouTube channel if you feel that this channel is giving some valuable information to you. Thank you, guys. Bye.